Ever walk into tax season feeling like you've got it handled, then realize you can't remember the difference between a deduction and a credit? It's like mixing up a coupon code with a gift card. One just discounts your bill, the other wipes it out. Veronica, CFP and principal at CapTrust, breaks down the real difference between tax deductions and tax credits, and why knowing it could keep more money in your pocket. Point 1. Deductions are like discounts on your taxable income. Karis explains, a tax deduction reduces your taxable income, while a tax credit reduces your tax liability dollar for dollar. For example, if you're in a 37% tax bracket, a $10,000 deduction saves you about $3,700. Not bad. But let's compare. Point 2. Credits are the real power move. As Karis puts it, a $10,000 tax credit knocks $10,000 right off what you owe the IRS. So credits are generally more powerful. Translation? Deductions soften the punch. Credits take the punch away. Point 3. Use both. Deductions can come from mortgage interest, charitable donations, or business expenses. Credits can show up as childcare credits, education credits, even energy-efficient home upgrades. Karis says, the bottom line is that deductions soften the blow, while credits can eliminate tax owed outright. So planning for both is key. Point 4. Watch out for mistakes. Not all deductions qualify. Some credits phase out with income, and carry-forwards, like unused charitable deductions, can save you later if you track them. So when tax season rolls around, remember this. Deductions are your friendly coupon code. Credits are the full-on gift card. Use both wisely, and suddenly tax season feels less like a pile of bills and more like a clearance sale. Got a money question? Head to GoBankingRates.com and ask away for a chance to win $500. Plus, your question could be answered by a top financial expert.